Good morning, everybody, and welcome to our breakfast with the tax team. It's been a while since we had one of these sessions, only because, again, we haven't had a budget in pretty much 1.5 years, and there really hasn't been much going on in the tax world. A lot of anticipation of things that could not happen. Prior years, there was talk of changing capital gains that's been wiped out, and lots of things. There were lots of things going on, but nothing in the end was actually implemented, or a lot of things were not implemented. Anyways, we finally got our budget for 2025, and interesting. There were about 2 or 3 things that we spent as an accounting firm. We spent a lot of time on in the previous years. One specifically on the underutilized housing tax, which was a tax paid on vacant properties held by non-residents. A lot of work was put into that. It was a total money grab. Again, that's been one of the items that's been canceled. So, but overall, I think from a tax perspective, there's a few things, but nothing that wowed us. No surprises really. Overall, we all know the budget, a lot of spending in there, so it will be interesting to see where the government's going to get this money from. Hopefully not yours and my pocket, but that's where it seems like it's going to be coming. But anyways, without further ado, I will pass it on to Mike Cosentino, who will take you through the updates. Thank you.
Great, thank you, Richard. So today we've broken this down into a couple of subtopics. First, an overview of the budget, what changed, and what may have disappeared. We will then discuss the business tax measures that have gone through that are in this budget, followed by the personal tax measures, then wrapping things up with administration and compliance updates before we get to our question and answer period. So a bit of an overview on this budget. So the focus of this budget, there wasn't much in terms of tax measures. Most of the focus was on making what the government calls generational investments in the housing, infrastructure, defense, productivity, and competitiveness areas. And to do this, they have proposed the following deficits over the next 5 years that you can see on your screen, highlighted by the proposed 78.3 billion deficit that they plan to run for 2025-2026. As I mentioned, not many significant changes regarding tax measures, but we did see certain big components of the previous 2024 federal budget get scrapped. The first one being the increase in the capital gains inclusion rate, which last year took up a bulk of that budget presentation. So the government did not go ahead with increasing the inclusion rate from 50% to a 2/3 inclusion rate. So capital gains realized are still 50% taxable. And the other significant item from the 2024 budget that was scrapped was the Canadian Entrepreneurs Incentive, which was going to allow business owners that sold certain businesses a reduced capital gains inclusion rate that was over and above their capital gains exemption on a sale of property. It was a very complex set of rules, and there was a long list of exclusions of what businesses were not eligible for this incentive. It was probably easier for the government to just indicate what was eligible, but nevertheless, this incentive got completely removed and is no longer being pursued. So now we are going to move on and discuss a few of the business tax measures that were mentioned in this year's federal budget. And the biggest one is what the government has coined the productivity super deduction. And essentially, this has two components to create this super deduction. So the first thing is what I personally like to call a reset of the accelerated investment incentive. And I call it a reset because this was already something in place and was still in effect to some degree. But now we are essentially starting the program from the very beginning all over again. So the accelerated investment incentive, it was originally introduced back in 2018 and was in the process of being phased out over the next couple of years. However, they are looking to reset this eligibility for capital asset additions on or after January 1st, 2025. So what this accelerated investment incentive will do is that most capital asset additions are going to be entitled to 3 times greater tax depreciation or capital cost allowance, or CCA, whatever term you prefer. You get 3 times greater CCA in the year of acquisition versus the original rules before the accelerated investment incentive was in place. This also returns as well 100% immediate expensing for manufacturing equipment, clean energy equipment, as well as zero emission vehicles. And these enhanced deductions are to be effective through to 2029. And after that, we will see a phase out of these benefits over the course of 2030 to 2034. The other component of the productivity super deduction is the ability to immediately expense the purchase or the renovation of manufacturing and processing buildings. So this is something that was not previously covered as part of that accelerated investment incentive that I just talked about. This can be pretty significant here. It will apply to all eligible buildings and or eligible building additions acquired on or after November 4th, 2025. So after the budget date. In order to qualify that building as manufacturing and processing, there's a minimum 90% floor space requirement of the building to be used in manufacturing and processing activities. And in order to get the 100% immediate expensing, the building must be in use, or the renovation or the addition made to such buildings must be in use before 2030. There is a partial incentive that will exist between 2030 and 2033, just at a reduced rate. So if you miss the 100% expensing, you have there will be a 75% first year deduction, but available for 2030 and 2031. Otherwise, there would be a 55% first year deduction for 2032 and 2033. So still some benefit there in those later years, but not nearly as strong as getting 100% expensing in that year the building first becomes in use. So the next couple of slides here are some illustrative examples of the accelerated investment incentive. So the first example here, we're looking at most capital asset additions that are outside of manufacturing and processing. They're not clean energy equipment, and they're not zero emission vehicles. So we're looking at an example here. Let's say we had a CCA Class 8 asset addition of $1,000, and for those of you, just as a reminder, CCA Class 8, that's generally your general purpose equipment, as well as furniture, other fixtures. So that's generally what we're talking about here. So if let's say we bought a nice couch for our boardroom, for instance, just to make things a little fun. Before the accelerated investment incentive rules came in, you would have a half-year rule, which reduced the amounts you could claim for CCA in that particular year, and then you would multiply it by the CCA rate in order to get that CCA deduction. So before the accelerated investment incentive rules, essentially the math works out to getting a CCA deduction of $100 in the first year of use. The existing rules that were in place are still in place because I mean this is all proposed right now. None of this has actually been made into law yet. But with the existing rules, we are currently getting double the amount that you would typically get as a CCA deduction. So on that $1,000 capital asset addition, we're getting $200 a CCA. With the rule reset, we are going to be able to get triple the amount that we would have originally been allowed to claim. So So instead of the original $100, in that we would be able to claim $300 in that the first year of acquiring our Class A asset. For our next example, we're looking at manufacturing and processing equipment, the manufacturing and processing buildings, clean energy equipment, as well as zero emission capital assets. So for instance, we're going to assume a $1,000 CCA Class 53 edition, which is for manufacturing equipment, which is so if we had a $1,000 edition before the accelerated and investment incentive rules kicked in, we effectively had a CCA deduction in the first year of $250. With the existing rules that are currently in place, we effectively get triple that amount. So we're looking at $750 there. And then with the rule reset, we would get 100% expensing. So in this situation, we get that 4 times our original CCA deduction, and we get that full $1,000 as a CCA deduction. So a bit of an illustration here on the increased first year deduction versus what was the case in the past. And another component of the tax business measures discussed in the budget related to the scientific research and experimental development category, which we call SHRED for short. So the budget is proposing essentially enhanced tax credits through this program, and to achieve this, they are proposing to increase the expenditure limit that a company can have for SHRED expenses from $3 million to $4.5 million. There typically is a phase out when you're looking at a associated group of companies, and they're looking to increase that phase out so that more businesses are eligible. So the previous phase previous phase out, I believe, started at $10 million. They are now having that start at $15 million, and now the full phase out occurs at $75 million. And then one final thing with the SHRED expanded eligibility, they are looking to allow capital SHRED expenditures to be eligible for deduction, both against income and then also be eligible for the investment tax credit component of the SHRED program. Providing that could potentially provide a substantial benefit there. The government announced some clean economy incentives, which we will not be spending too much time on. But just for everyone's knowledge, that there is expanded eligibility for the critical mineral exploration tax credit, the clean technology manufacturing credit, carbon capture, utilization, and storage credit, as well as the clean electricity investment tax credit. Essentially, the government is proposing for several new critical minerals that would be eligible to be claimed as part of these various tax credits that's which will give more more eligibility. So that's all we have here. But the last thing I wanted to go over, and this is the bit of a potential trap for some corporate structures, is the dividend refund suspension. And this is proposed to be for taxation years that begin on or after the budget date of November 4th. So essentially, what is going to happen is PayerCo will have their dividend refund suspended if the following conditions are met. So one, PayerCo and ReceiverCo are affiliated with each other. And generally, that's going to mean that both corporations are controlled directly or indirectly by the same individual and or that individual's spouse or common law partner. And condition two, ReceiverCo's taxes payable are due later than PayerCo's tax payable. And we'll go over a brief example in a minute or so. So the result is that dividend refund being suspended, and PayerCo only receives that dividend refund once ReceiverCo pays a dividend to either an individual shareholder or to a non-affiliated corporation. So if we take a look at a example structure that would be caught under these rules, you have Mr. X, who owns 100% of X Holdco, which has a November 30th year end. X Holdco owns 100% of X Opco, which has a December 31st year end. So at first glance, X Opco and X Holdco, they are going to be affiliated with each other as they are both controlled either directly or indirectly by Mr. X. If X Opco was to pay a dividend that was eligible for a dividend refund as of its year end of December 31st to X Holdco, let's say that's this dividend's paid December 31st, 2025. X Holdco does not recognize that dividend as part of it until their November 30th, 2026 year end. So if we so with X Opco, with paying that dividend December 31st, 2025, their 2025 year end, the deadline for when its X Opco's taxes are due is June 30th of 2026. where with ex holdco, since we're looking at the November 30th, 2026 year end, then its filing deadline is not until May 2027. So since ex holdco's filing deadline is going to be later than ex opco's filing deadline, any dividend refund that ex opco was supposed to receive has now been suspended and will not be paid out until ex holdco pays a dividend to Mr. X. There are a couple of exceptions to the suspension rule here. So in one case, so if subsequent dividends to the individual shareholder are paid by the date that PayerCo's taxes are due. So essentially, if you move that dividend immediately up the chain to that individual shareholder, then the dividend refund suspension rule won't apply here. There's also a exception in the event that there was an acquisition of control of PayerCo within 30 days of making this dividend payment. We are not currently sure on how the government plans to track when a dividend refund will be suspended, what information will be available. Is there going to be a new like sub account set up that will hold our suspended dividend refunds until they're paid out? There's still a few questions to be resolved there. But one thing that could be considered in the event that these rules do come into place is considering to submit a fiscal year-end change request to the CRA so that you can align the year-end of PayerCo and ReceiverCo. So if we go back to this example here, if we send a request to CRA to change ex holdco's fiscal year end to be December 31st, the exact same year end as ex opco, then we do not have to worry about the dividend refund suspension rules applying. And that was everything that we had for business measures. Moving on to a couple of personal tax measures. With the biggest personal tax measure getting announced, the personal support workers tax credit. And this is proposed to apply for the 2026 to 2030 taxation years. With this credit, it's going to allow a refundable tax credit equal to either the lower of 5% eligible T4 earnings or $1,100. To be eligible for this credit, the worker's main employment duties have to be helping patients with mobilization and daily living, and they must work at an eligible healthcare establishment, with some examples being hospitals, nursing care facilities, residential care facilities, community care facilities, as well as home healthcare establishments. And in addition to all of that, in order to be able to claim this credit on their personal tax return, they must get a certification from their employer that indicates that they are eligible to claim this credit on their tax return. Other personal tax highlights. So first of all, we got confirmation that the plan is still to lower the marginal tax rate for the lowest personal tax bracket. That is going to decrease from its current 15% to 14.5% for 2025, and then lower further to 14% in 2026. The issue then came that if they lower the lowest marginal tax rate, that then has a negative impact on the tax credits that rely on that lowest marginal tax rate. So to help with this, they created a top-up tax credit to that would be in effect until 2030. So essentially, all tax credits that rely on that marginal tax rate, even though the rate has lowered to ultimately 14% in 2026, tax credits are still going to be calculated based on the original 15% rate that we had up until this year. We received confirmation that the government is still going to allow a lifetime capital gains exemption limit of 1.25 million on qualifying sales. This first came up when they were proposing to increase the capital gains inclusion rate. So they as we mentioned before, that increase got scrapped, but they kept the increase for the lifetime capital gains exemption limit. They also the budget also confirmed that the GST relief for first-time home buyers for newly constructed homes. With this credit, a first-time home buyer will get GST relief up to $50,000, aka 5% of $1 million. For buying a newly constructed home, if they buy a home that's between $1 million and $1.5 million, then there's a phase out of the GST relief that person is going to get, and then with no GST relief occurring if that home is more than $1.5 million. There's some modifications to the home accessibility tax credit. Essentially, what's happening in the past is you had the ability to claim both the home accessibility tax credit as well as the medical expense tax credit if that particular expense ended up being eligible under both programs. They're looking to tighten up the rules to make sure that that expense can only be claimed under one program or the other. And then finally, they proposed automatic tax filing for qualifying low-income individuals, given that they meet certain conditions, such as they haven't filed their personal tax return in several years. And they have not decided to voluntarily file a tax return on their own. That's a couple of the conditions there. That's where the CRA may choose to do automatic tax filing, which the purpose here is to allow those low-income individuals to get access to certain benefits that they can only receive if they file a tax return. We're getting near the end here, and we are going to wrap this up with some administrative and compliance updates. So a little potpourri, if you will, of some final tax topics in the 2025 budget. So first, as Richard mentioned at the top of the presentation, the underused housing tax was eliminated for the 2025 calendar year, as well as subsequent calendar years. They have also partially eliminated the luxury tax, where it no longer applies to aircraft or vessels or boats as of November 5th. However, the luxury tax still stays in place for the purchase of vehicles that are valued at over $100,000. So that's still in place. The government has been looking to increase trust filing requirements to include bear trusts as part of those requirements. They initially tried to do this a couple years ago, and then one business day before all these returns were due, the government came out and said that actually these trust returns are not going to be required at this time, as they wanted to revisit the rules they made and make adjustments in terms of what particular bear trusts they wanted to report. The government's still in that process, and as a result, they are deferring the filing requirement for bear trusts again. So now we are looking at the 2026 taxation year, where these trust filing requirements might apply to bear trusts. There was also supposed to be expanded reporting obligations for nonprofit organizations. That also has been deferred, and that has been deferred to taxation years beginning on or after January 1st, 2027. They are looking to close loopholes regarding the 21-year deemed disposition rule for trusts as part of this budget, and then as well looking to align the transfer pricing rules within the Income Tax Act to more closely match international standards to help improve some synergy there. A couple more items. The budget mentioned the CRA receiving $77 million over the next 4 years to target non-compliance in the trucking sector. So for those of you that are within that sector or have clients within that sector, it may be a good idea to consider, preparing for a situation that the CRA decides to look at you, making sure you have the appropriate books and records in place in the event of a CRA review or audit. The CRA wants to process faster, low-risk shred claims, and they plan to increase their use of AI in order to achieve this. So we will see if that has any benefit there. And then finally, an HST tidbit on osteopathic services. So osteopathic services will be subject to GST, HST if they are performed by individuals who are not osteopathic physicians, and that effectively occurs as of November 5th. So that's everything that we have for you today in terms of the 2025 federal budget. As Richard said off the top, not a terribly large amount of things to go through. Nothing really surprising in terms of curveballs, and overall it's a fairly safe budget in terms of not trying to rock the boat with things. So with that said, we have a few minutes for questions if there are, which I'm sure there are.
Thank you, Michael. So we do have this one question here, which basically is, what is the definition of an M&P, so manufacturing and processing building? And I think really for purposes of the accelerated write-off measures that have been proposed, really it's what qualifies for that is the actual space. So in order for the building to qualify, 90% of the space, the building space, has to be used in the actual manufacturing and processing production. So the office space or things like that would not qualify. So again, the 90% of the building has to be in the actual production of the whatever the product is or things like that. So other than that, there's no specific rule. It's more about the space. So I don't know if there's any other questions. Right now, we don't have anything else. But again, if something comes up, as Chris mentioned, we will share the recording. If something does come up and you do have any other questions, feel free to reach out to Michael or myself, and we'll get you some answers.